Brookfield Asset Management just reached a new peak on the TSX Composite Index. Most headlines will tell you that is a good sign for Canadian markets, a vote of confidence in the sector, and a reason to feel constructive. That is the consensus. And the consensus is only half the story. The real question is not whether Brookfield went up. The question is, why now? What structural forces are underneath this move? And what it actually signals about where capital is flowing at a global scale. That is what this video is about. Let us start with what Brookfield actually is, because the label matters. It is not a bank. It is not a traditional fund manager in the sense most retail investors picture. Brookfield Asset Management sits at the intersection of two of the most powerful capital trends of the past decade: the institutionalization of infrastructure as an asset class, and the global search for yield in a world where fixed income no longer delivers real returns reliably. The company manages assets across renewable power, infrastructure, real estate, private equity, and credit. But the core engine, the one that drives long-term fee income and explains why institutional allocators keep sending money its way, is infrastructure. Toll roads, utilities, data transmission networks, ports, pipelines. Assets that generate predictable, inflation-linked cash flows over 20, 30, sometimes 50-year time horizons. Here is the first thing most viewers will not have fully internalized. Infrastructure as an institutional asset class barely existed 30 years ago. Pension funds and sovereign wealth funds held bonds and equities. The idea that you could package a toll road or a fiber network into a vehicle that delivered bond-like stability with equity-like upside over long cycles was genuinely novel. Brookfield was among the first movers in scaling that idea globally. The new peak on the TSX is in part a reflection of that structural first-mover advantage finally being priced more fully by the market. Now, here is the reversal card, the point most people are missing when they look at this headline. Everyone understands that infrastructure is defensive: inflation protection, long-duration cash flows, low correlation to public equity volatility. That story is well known. What is less understood is the fee structure transformation that Brookfield has been executing beneath the surface. Traditional asset managers earn fees on assets under management. When markets fall, AUM falls, fees fall. It is a cyclical business dressed up in stable-sounding language. Brookfield has been systematically shifting its revenue base toward perpetual capital vehicles and long-dated closed-end funds, where fees are locked in regardless of short-term market movements. This means the earnings profile of Brookfield Asset Management is becoming structurally less volatile than its peers, not because the underlying assets are risky, but because the fee architecture itself is becoming more durable.
When you combine that with the secular growth in infrastructure demand, specifically the electrification build-out, digital infrastructure expansion, and the energy transition requiring trillions in new capital deployment, Brookfield is not just riding a wave. It is one of the few platforms with the origination network, the operational expertise, and the capital relationships to actually deploy at scale in those sectors. That is a competitive moat that is genuinely difficult to replicate quickly. The second thing most viewers will not have considered: the Canadian dollar angle. Brookfield earns a significant portion of its fees and carried interest in US dollars and other hard currencies, but it is priced and benchmarked on the TSX in Canadian dollars. When Canadian dollar weakness persists relative to the US dollar, Brookfield's reported earnings in Canadian dollar terms get a passive translation boost. The new TSX peak is not just a story about Brookfield's operating performance, it is partially a currency story, and that distinction matters for how you interpret the sustainability of the move. So, where does this go from here? Let us build the scenario branches honestly. If global infrastructure investment continues to accelerate, driven by government spending mandates, energy transition timelines, and the AI-driven build-out of data center and power infrastructure, then Brookfield's pipeline of deployable capital becomes increasingly valuable. Institutional allocators who are still underweight real assets relative to their target allocations will continue flowing money into platforms like this one. In that environment, the fee income growth trajectory remains intact, the perpetual capital base expands, and the current peak on the TSX looks like a midpoint rather than a ceiling. If, however, interest rates remain structurally higher for longer than the market currently expects, the calculus shifts in a specific way. Higher rates do not destroy infrastructure as an asset class, but they do raise the required return hurdle for new deal underwriting. That means Brookfield may deploy capital more slowly, which delays carried interest realization and compresses near-term earnings growth. In that scenario, the stock consolidates, valuation multiples compress modestly, and the question becomes whether the long-term compounding story remains intact, even if the near-term earnings cadence slows. The recovery path out of that rate scenario is worth naming explicitly. If Brookfield uses a higher rate environment to acquire assets at better valuations, essentially buying infrastructure cheaply when others are forced sellers or unable to finance deals, then the patient capital advantage becomes a genuine alpha generator. The platforms that have deployed through rate cycles before, and Brookfield has, tend to emerge from those periods with stronger portfolios than they entered with. The one-line wrap on all of this is this. Brookfield hitting a new peak on the TSX is not the story. The story is that the market may be beginning to recognize the difference between an asset manager that grows with the cycle and one that compounds through it. Those are two very different businesses, and for long-term investors, that distinction is worth understanding deeply before the rest of the market catches up to it.